Schedule A.
Hi, welcome back. I wanted to continue talking about the structure of the 1040 and some of the basic forms that feed into it to help you understand how your tax return is organized and where all these numbers are going. For those that may be new to taxes or never really thought about it. So we talked previously about schedules 1, 2, and 3. 1 is other income, 2 is extra tax, and 3 are credits and payments. But these forms, they name them Schedule A, B, C, D, E, are the top 5 forms that most taxpayers use when they file their own tax return. They all show up on this tax return, either on page 1 or page 2. Most of them are on page 1. So Schedule A, for instance, is right here, down at the bottom, Schedule A. And then Schedule B is right there. Schedule C is on other form on Schedule 1. So let's just start with Schedule A. Schedule A is a very popular form, itemized deductions. You have a choice depending on if you have deductions or you want to itemize. And how do you know which one is more? Well, it depends on the current year's standard deduction. Let's say it's $13,500 or $14,000. It changes. It goes up $900 every year. If your itemized deductions are less than that amount, calculate it, but just go with the standard deduction. They raised it. And this, by the way, this goes away in 2025. It goes back to half of whatever it is based on the 2017 tax cut law. I'm sure Congress will reinstate it, but it's set to expire. So let's say it's $13,000, $14,000 a year. Now it's going to go back to 7. But right now, let's say it's 14, depending on your age, 13, 14, 15,000. If your deductions are greater than that, you want to use the itemized deductions. There's basically 5 parts. You got the medical and dental. If those expenses are greater than 7.5% of your income, go for it. Taxes you paid, property taxes, state taxes. The problem with this is now it's capped at 10 grand. No matter how much you spend in property tax, you can only deduct 10 grand. The biggest piece for homeowners is mortgage interest. And this is where you would deduct your interest if your loan is $750,000 or less, a recent loan. If you have a $3 million loan, you can only deduct interest up to the first $750,000. And that would be on here. And then gifts to charity, if you have casualty losses, and anything other. So whatever this number is on line 17, that is going to be reported over here on line 12. It says I don't know if you can see it, but it says standard or itemized. So you want to go through the calculations. If it's close, ask your tax preparer to run them anyway so you can see where you stand, but always go for the higher deduction, obviously. Schedule B, very straightforward, interest or dividends. And those are going to come off your 1099 interest or dividends. These get reported into whether it's interest dividends or foreign trust, qualified dividends. So this is a form where it just captures all of those dividends and interest that you're earning, hopefully. If the interest rates are going up, you can get a little bit more. That's where this goes. Schedule C is our popular form. We talked briefly about it. We'll go in more detail. But Schedule C is when you're self-employed, sole proprietors, and basically you want to put the 1099, the net non-employee compensations, they get reported here. And anything that's not reported, some clients will say, well, I didn't get a 1099. Like, well, that's great, but you still got to report because it could be found out. If you've deposited the money, it's going to be known, or you have, they can do the math and say you've had 20 clients times X per client, you should have X amount of dollars. And so all your income gets reported in box 1, and the expenses is where you can go crazy and look for those expenses that are reasonable, necessary, ordinary, paid in the year. We talked about deductions. Bang all of those into this part 2, home office expense. If you work from home, it has to be an exclusive area. We can talk about that in another section, but those home office expenses. And that number will get reported on Schedule 1, which we talked about previously. And then Schedule D, we're going to go into that in another section. Capital gains and losses. This is when you sell a stock or a bond or a property, a house, a car, anything that has value and you've held it for 1 year or less than a year, depends on your holding period. We want to go into that later and see how you can minimize that gain. And lastly, Schedule E is your other supplemental income, primarily from, you could either be renting, or you could have royalties, or you could have partnerships or S corps. So the sum of these two, anything passive, anything that's passing through to you, whether active or passive, gets bundled up in Schedule E, and they offset each other. So if you had a gain on one and a loss on another, the passives offset each other, and then the actives offset each other. The sum of it goes over to Schedule 1, the other income. So that's the basic architecture of the tax return. You can go into each of these areas, see where you have a lot of activity and how you can structure it with your accountant to get the best transaction and the lowest tax. All right, hope that helps. Thank you.